The advantage of having a weekly call is you get the call up closer to the market. It reduces capital in the trade, and if you have the call up close to the actual market price, then your actual risk in the trade becomes a lot less, because the call can only lose, if I have a 1,000 strike call on and the Russell's at 2,000, I have all that money I can lose. But if the Russell's at 2,000 and I have a 90 call on, then I can only lose $10, and that's it, right? There's no more loss under that. So that's the advantage of that. The reason sometimes we have a call is for the volatility pop when the market comes down. If I do a weekly far from the money, I don't get that, because one of the things with a weekly is a lot of times they won't pop in volatility unless the move is enormous, because they're decaying so fast and they're so close to expiration. A lot of times you don't get that. So you have to keep that in mind. Also, even if you're only buying, say I have a $5 time premium in a monthly and I have a $1 time premium in a weekly, I have to consider that I have to buy that weekly 4 times, and if it remains $1, I'm still spending the $4 or $5. And also that time premium is burning off very, very quickly because I am very close to expiration. So those are all things to consider. You kind of have to weigh that out and decide I'd rather go to a weekly call or not.